Welcome to Commercial Real Estate Now in partnership with CBRE Econometric Advisors and my co-host, Dan Diebel. I'm Carly Iacono. Dan, lovely to see you again. How's everything?
It's great. It's great to see you again, and great to see you again after we saw one another in person for the first
Yes,
time. So, yeah, this is great. Glad to be back.
that was a stellar event that CBRE Econometric Advisors put on in New York City at the Stock Exchange. What a cool research-oriented event with some great people there. So happy we could overlap.
Yeah, it was super cool. A lot of fun. Very fun for our particular group of economists who all got to nerd out a lot by being on the stock exchange. And one of the cool things about like working for CBRE, if I can just, get on my soapbox a little bit, is that it is a publicly traded company. So when we were on the stock exchange, like they put CBRE up on all the TVs and stuff, and it just felt very,
Special.
neat. Yeah.
Yeah,
Uh,
yeah. I love that we spent a day talking about data and outcomes in dizzying detail, and we're both like, that was a blast. That was so great. But it was really a room with a lot of data for many hours, but it was very interesting. Good stuff.
yeah.
Good stuff. Okay, let's jump into today's episode. We are covering the proposed tariffs and then the health of the American consumer. And this is something we've never covered on the podcast. I think it is so timely and very, very interesting from a retailer and investor perspective. And I'm just going to take a second and set the framework and say, this is not political commentary from either of us, even if it feels like we might feel one way or the other. We are not giving political commentary and definitely are not sharing the views of CBRE corporate. Got to be careful there. So everyone listening, take it with a grain of salt that we are looking at tariffs and consumer health strictly from a what could be data perspective and what that might mean for investors. Did I miss anything, Dan?
No, not at all. I'll double down on the not political, just kind of with a little bit of history on tariffs before we discuss the current tariffs. Is that tariffs are able to be enacted by the executive branch because the executive branch oversees foreign policy. Most modern presidents have enacted tariffs in one way or another. Our most recent president, or our current sitting president, President Joe Biden, enacted tariffs on China. Before him, Trump enacted tariffs on China in 2018. Before President Trump, President Obama enacted a slate of tariffs across multiple countries, also targeting China and some Chinese goods. So, tariffs have been being used by presidents for a long time because it is one of the things that they have good flexibility with. And only recently have we really seen an uptick in the use of tariffs by the presidential branch. Previously, if we go back to like Bill Clinton era, tariffs were used mostly as a bargaining chip and rarely went into effect at high levels. So just as we discuss tariffs, we want to kind of remember that this is something that is not a politically partisan thing, and both sides of the aisle have used tariffs in the past. Some of them have used them better than others. But
That is just phenomenal context because that is not at all how it's being portrayed in the mainstream media. Like I said, this is not a topic that, 4 years ago we were chomping at the bit to cover. Maybe it was brought up, but not with the fervor that it is being discussed right now. So I think keeping that in historical perspective is huge. Thank you for laying that groundwork. So we've talked about tariffs throughout history. They're not new, but they're back on the table in higher amounts. What's different this time around?
Boy, higher amounts and broader reaching tariffs. So there are currently, as of filming this, the incoming administration under President Trump proposes a 60% tariff on all goods from China and a 10% tariff on all goods imported across the board. And now that broadness of tariffs certainly has not been seen before.
Got
This,
it. That 10% is really the one that's raising eyebrows because it's so ubiquitous. Is that the case?
well, both are quite ubiquitous.
Okay,
60% is a very high level of
got
tariffs.
it.
Right?
Okay.
If prices on any good, earlier this year, or oh my gosh, was it last year when egg prices
Oh,
spiked
right.
up?
Went to like $8 a carton, something absurd. Right.
Yeah, that's a huge rise in price, and that garners a lot of attention. A 60% bump in all of the goods that we get from China in terms of the price that importers are paying is a very large bump in prices. So that garners a lot of attention. But also the 10% on all foreign goods garners a lot of attention.
So baseline, how would tariffs work? How are they passed on? It's not a direct, okay, let's say the 60% passes, which as we both know, there are many, many iterations of any political policy. So it's likely going to change several times before being passed. But let's say it's passed as it's being proposed right now and it's 60%. Would you say that would be a direct translation, or is it going to be absorbed along the supply chain?
So without getting too much back in the classroom, I did get to teach how tariffs work just like that when I was teaching graduate level macroeconomics at Boulder.
I didn't know this was a class. Really? Wow. Here we just thought we were doing a podcast, but I had no idea you taught an entire class on tariffs. Okay, I'm ready.
Yeah, I won't get out the whiteboard, and I won't talk too much about the slopes of lines and elasticities, and I won't graph anything out here.
And I wish you would, but okay.
We can pull out the whiteboard at some other time, really force the podcast on our consumers.
Right.
But in terms of the pass through of the tariff, and that's what we call pass through. So what we might be most attuned with previously is the increase in minimum wage. Now, when the minimum wage goes up, oftentimes consumers or the American public will think, oh, well, all of the goods are going to increase by that same amount. But it's never a one-to-one. And the percentage of an increase of a price that gets passed through to the consumer is what we call pass-through. So with a tariff, the importer is going to pay the increased price. So let's say I'm importing electronics from China. I will still pay the same price to China that I paid before, but then I will pay 60% of that price to the American government as a tariff.
Got it. So it's not necessarily the manufacturer. It could be a third party who imports the item.
It will exclusively be the importers of
Got
the
it.
items that pay the tariff.
Interesting. And are those normally an arm of the manufacturer? Are they almost always a third party?
Oh boy. So
it's going to be a long episode, everyone. Just buckle up. We got a lot here.
Right. Yes and no. The U.S. often exports a lot of intermediary goods. So we export like steel beams or something, and then they get created into something else, and then we import them back. So we export a lot of minerals to China, like gold, for instance, for computer chips. They make the computer chip and then they send it back. So when we import the computer chip is when the tariff is going to be paid.
Okay.
So the manufacturer is not paying the tariff. It's always paid by the importer.
Got it.
How much of that gets passed through does, like you're alluding to, matter about the supply chain, and in particular, what we call the demand and supply elasticities, which is just how responsive are the firms supplying the good and the people purchasing the good, how responsive are they to changes in price?
And that has to be a sliding scale depending on what item we're talking about, right? I would think some goods are considered value and could be inflated a little bit without too much change in demand, and some maybe have already kind of hit their peak to the consumer. So I would imagine that's a big range.
Yes, it is a huge range, and you're absolutely spot on. The less responsive consumers or producers are to price, the more inelastic the market, which means more of that tariff is going to get passed all the way through onto the consumer.
Right. Because they can without affecting sales.
Precisely, exactly. And examples of that are like oil, right? Gasoline, it's very hard to change. The US's consumption of gasoline is very hard to change, even though as an individual, I may be able to change my gasoline consumption. I still want to buy goods from Target, or I still want to buy goods from my local retailer. And that requires gasoline for the trucks to get the goods there. So it's very inelastic, that market. However, the market for Christmas ornaments, let's say, is highly elastic. I don't need to buy another Christmas ornament. I didn't need to buy the 5 Christmas ornaments I bought in New York recently, but I did it.
Story
If
of my life.
suddenly those were all 60% more expensive, I would buy a lot less, which means they can't pass through as much of that tariff to me.
Understood. So is this, in your mind, a category by category, or is it as detailed and niche as Christmas ornaments versus throw blankets at Target? Is it going to be, are the impacts going to be varied on a per item basis, or do you think we're going to see some generalities across different categories and retail segments overall?
Yeah, so I think we can separate it into necessities and non-necessities first. And those necessities will see the highest price changes with the lowest amount of reduction in purchases. As we move towards the throw blankets, which we also have so many of, and ornaments, those non-necessities, we're going to see less of an ability to increase the price to make up for having to pay those tariffs because the consumers are more responsive. So it will be divided along those lines in terms of how much of a necessity versus how much of a non-necessity a good is in terms of the effects of the tariffs on it, and of course whether it's coming from China or not. Right? If we want to talk about clothing manufacturing, there are a lot of substitutes. Bangladesh has a lot of clothing manufacturing. I mean, pick another developing nation that produces a lot of textiles and clothing, and retailers will pivot, and they will have incentive to pivot away from tariffed goods to these other goods that are still imported, which is where, yeah.
No, I was going to say, you started to go down the supply chain road, which is interesting. And I want to swing back to the retailer, but let's continue with this. How much of the supply chain do you think can be shifted? And this is an impossible question to answer because there's so many variables. So I'm not looking for a number here, but conceptually, you brought up clothing. Are there supplemental manufacturing capacities in your mind in other parts of the world to absorb microchips, cars? I don't know. How flexible is the supply chain really?
Right. Yeah. I mean, it's very flexible when we're talking goods with a lot of available substitutes like clothing. It's less flexible when we're talking electronics. I don't want to start a talk on the CHIPS Act or the national security concerns around producing electronics at home in the US. But currently, we as a nation do not have that capacity, and we do import a lot of our electronics. We import a lot of them from China. So a 60% tariff on those electronics is going to make prices go up and going to be very, very difficult for the US to deal with if we do not have our own substitutes available.
And I've seen some talk or some articles already on ports being backlogged with goods from retailers trying to stockpile certain materials. I would imagine that's a very short-lived answer and response, just sort of a quick, what can we do right now? But obviously they're going to work through those goods in the near term, I would assume. Do you think that there will be, because this affects commercial real estate significantly, do you think there will be a shift in the flow of goods through different ports as they come from other countries? And is that temporary based on history, or should we see real material shifts in the way we receive goods?
This is a great question. And luckily, my counterpart at Econometric Advisors, Nicholas Rita, who is our industrial economist, is currently working on a paper that I think you got a little preview of at the conference about the last time that like tariffs were instituted around 2018. And suddenly we saw a lot more truck crossings from our southern border than we would have expected. We
Right.
saw an increase in truck crossings above and beyond the manufacturing capacity that Mexico has. And there seems to be evidence initially that it was China avoiding the tariffs
Mm.
that were instituted in 2018 under President Trump. So, yes, the port activity is likely to change. What would be most likely would be that they avoid US ports, especially if the tariff is set incredibly high. And avoidance of tariffs is one of the reasons why economists don't really love them as a tool, because they are pretty easy to avoid. You ship your cargo down to Mexico and then you bring it across the southern border as opposed to shipping to a US port. So it kind of can hurt in two ways. It hurts US ports, and then it hurts government revenue because the avoidance of the tariff lowers government revenues. And similarly, we get less economic activity at our ports, which can create a little bit of consternation.
I would think that that could be tracked and vetted out and figured out. But I guess there's, with any new rule or law or tax, there's people who find workarounds. But that's amazing to me that it would be on a grand scale, that that would work.
Mm-hmm. Yeah.
So let's take this in a slightly different direction. We started the episode talking about the elasticity of demand in different categories. For the retailers that maybe can't pass on the price increase that they're feeling, do you think there's certain categories where maybe margins are already thin? Or do we feel like overall retail is still healthy, which I know is the case, but could we see some of those thinner margin businesses that can't pass on the price increases start to feel a little bit of pain?
Yeah, I think that's the way to look at it as well, is that what are the margins currently? And
Mhm.
if you have thin margins and are also relying on importing the goods you sell, then you're going to be in trouble. Now, some of those are these textile companies, um, or direct to consumer discounters. A lot of those are going to be at threat. Now, the direct to consumer discounters being at threat is not a threat to the brick and mortar space, as many of them that specialize in these products from China do not occupy brick and mortar space in the US. So it could be a boon for that. Having said that, a lot of the smaller shops, these smaller retailers, do import some of their goods from China because they are inexpensive to import and they give good margin. As you erode that margin, you either have to look elsewhere or you have to uh, up your prices in order to keep yourself in business. With the continued pressure on rental increases that we've seen post pandemic, I think that many of these smaller good providers that really make the vibrancy of retail centers could be in peril because they can no longer compete on the mass scale, and they can't afford the recent rent increases on top of having all their input prices increase.
Yeah, that's a great point. Your bargaining power on your cost of goods is completely different if you're Target or Walmart, or if you're a local, party gift store, right, in the town, which
Right.
probably is a lovely place to shop, but they're one location or two or three locations. They don't have the same ability to pivot their sources and negotiate for good pricing on their
Yeah.
cost of goods. So, yeah, that's unfortunate. Um, Hopefully, I guess for all small business, there are other suppliers or other countries that kind of fill that void quickly, because that is such an important and interesting piece of retail, is the local small business as well. So that's an unfortunate byproduct. Sounds like
Mhm.
would be that additional stress. Anything from a national retailer that you think could work out better? Is there any benefit to this? Let's say you are Target or Walmart. Do you think you get more consumer market share because your purchasing power is so great? Or maybe Costco. Do we think that more dollars are going to go to the mass merchandisers who have a national presence? Is there anyone who you think might benefit aside from the government?
Oh, I would assume the government probably wouldn't benefit from this. Collecting government revenue from tariff is just, it's very, very difficult. It would probably be more onerous to implement the infrastructure for collecting this many tariffs uh, than the government revenue you would end up getting. Like, you'd probably come out net positive on government revenue, but we don't have the systems in place to implement that policy. But that's a whole nother conversation.
Wow,
I shouldn't
yes.
go there.
I
I'll,
just
I'll
kind
get
of
back
threw
to
that in last minute, but that was an interesting little side turn there. Okay.
yeah,
Thanks for sharing that.
yeah. We can talk first, second best, third best, fourth best policies in terms of government revenue raising on another day. I think that, to your point around who's to benefit in terms of gaining market share, that's the only long-term benefit you would see. But that would create a lot of move outs from brick and mortar of these smaller retailers and concentrate even more power in your large national retailers, such as, Targets, your Walmarts. I'm not going to put Costco in that list only because Costco does a lot of sourcing of their own goods. A lot of their Kirkland brands are sourced, um, excuse me, are sourced within the United States. So I do think Costco might be an outlier here. I have not looked into any of their financials and how much they import or not, but I do know, uh, from what I know, from what they have shared. I've watched a few documentaries on how Costco became Costco and how then Sam's Club started competing with them. So there's a really cool story behind Costco and everything. But they do source a lot of their Kirkland materials either locally in the United States or from places outside of the US that are not China. And the last reports I've looked at, they are not very dependent on China at all, which means their prices could probably stay very stable, and they could potentially be a net benefiter if tariffs were in place. I know that's a lot of could, if,
Right.
maybe, we'll see. Um, but theoretically, they would be in a position to benefit, and they have been expanding very rapidly, building new Costco's, their expansion plans. They keep upping their guidance. So I wouldn't be surprised if Costco continues to benefit, tariffs or no. tariffs from the current economic climate.
Interesting.
Yeah.
We already think they're incredibly strong. So this is just one more, I guess, feather in their cap that maybe they wouldn't be affected where other retailers were. That was interesting insight. Yeah. Thank you for sharing.
And yeah, the other point that you brought up around, increasing market share, we've seen a lot of market share increases in retail already. The players keep getting bigger and bigger. As you talked about on a previous podcast already, the Kroger Albertsons merger has now been, I don't want to say officially blocked. They've
Yes.
officially attempted to block
Right.
the merger. And that kind of speaks to the climate that we have right now around mergers and acquisitions in the retail space and how much dominance retailers already have within the retail space. So they may not actually have as much to benefit from further consolidations of consumers as we would like to think.
Interesting. I didn't realize that we were potentially so close to that, let's call it saturation point of each category. At least I guess the FTC would argue in line with what you were saying that we are, and that's why they're blocking so many mergers. But that could be a political slant too. So we'll have to see what happens next administration on that front. So let's tie all this back to, or kind of weave in the health of the American consumer. We have some unknowns, but certainly some clear policies being talked about right now in terms of tariff. And we just talked through how that might affect the retailers, what might get passed on, what wouldn't. Do you think that consumers have capacity to absorb higher prices? How is the debt level? What's the overall landscape of the consumer look like right now?
Yeah. So I'm going to paint this in a context of 2019, in that the consumer health is about what it was in 2019, heading into 2020 before the pandemic hit. And we had a relatively healthy consumer and a healthy economy, so much so that the Fed was talking about raising interest rates during that time. The consumer is back at that point that they were in 2019. Most of the metrics are around that same point in terms of their savings rate, in terms of the debt that they're holding. The consumer looks very much like it did in 2019. So they do look relatively healthy.
That's great news. Wow.
Having
Is
said
there a
that,
but? Yep, I knew there was a but coming. I saw it. I'm ready.
It's not a but, it's an end.
Okay.
It's an end. And we are seeing that their delinquencies are starting to elongate. So even though debt levels are similar, we're seeing delinquencies starting to elongate. So there are more 90-day delinquencies versus 60 versus 30-day delinquencies, and the 90-day delinquency group continues to grow.
Right. That's a concern. I mean, there's a certain point that you can't get out of, right? The 90 that keeps extending, and then it's default. So that's seems like a concern that group would be growing.
Yes, consumers have less of an ability to extend and pretend than some of commercial real estate has experienced. But I'm sure there's much suffering in commercial real estate as well around held debt.
Right. So, I did notice that consumer debt overall is growing, right? Not just on defaults, but the amount that people are holding is increasing, even if they're paying off the minimums and meeting all the benchmarks, right? Is that a concern, or are we not at a level where that's ringing any alarm bells yet?
Yeah. So the debt, consumers actually did really great at paying off their debt during the pandemic. It turns out if you give them money and time and they can't spend their money on very much, they pay off their debts. So we did have a large bounce back of consumer debt growing at a quick rate and pace, but it's starting to slow down. The actual level of debt growth has been slowing.
Okay.
which is
Seems
why
positive.
right.
Yeah.
Consumer debt levels are at an all-time high. That is a factual statement.
Okay.
But we're kind of where we would expect to be if we had not had the pandemic. So we are kind of at a decision point. And if we start to see it increase again, if the growth rate continues to stay high rather than the growth rate coming down, then we're going to be a little bit more worried about consumers.
I have a quick follow-up question. When we talk about consumer debt level being high, being the highest it's been in some time, are you looking at a ratio between debt to income, or is it just debt in an absolute? Because if income levels have also gone up and debt's gone up, that would make sense, right? So is this an absolute or is it a ratio increase?
In absolute terms, it's the highest that it's ever been, except I might be off like a quarter or so. It might have been higher last quarter and then a little bit lower this quarter in terms of the absolute level.
Okay.
The metric that I do like is debt to disposable income,
Right.
that ratio. And that's holding pretty steady.
Okay. So that's a slightly different picture, right? Consumer debt's very high, but consumers still have the money to pay it off because their income is also higher.
Yes. And the caveat to that is that debt does not yet include these pay over time apps that have you pay in the short run without interest. There was a very interesting Fed paper that just came out on that, but I know that we're approaching the end and we can talk consumer debt and that pay over time, especially because the authors of that paper are really great. And I think they put a good paper together that should be considered as we think about consumers and how they hold debt.
Oh, let's make that a whole episode. I think we just teased it right now.
Right.
We framed it out. We're going to talk about consumer debt and what's normally recorded in the numbers, what's not, and the different pieces of that puzzle, because maybe it's not just one factor like you just brought up.
Yes.
Okay, good. I like that.
It's always more than one factor or
Right.
statistic or point of data. Yeah.
And that's just what makes it so interesting, right?
Yeah. Like just like your point around, is it the level that's the highest? Is it the ratio that's the highest? Is it the growth rate? What are we actually concerned about?
Right. Yeah. Right. And it seems like the ratio would be the most concerning if that got out of whack, but we're still watching overall debt levels.
Yeah.
To be continued on that front. Love it. So let's just tie this back to tariffs really quickly before we wrap up today. So consumer has highest level of debt, more or less, than they've had in a long time, maybe ever. Ratios are still healthy. Can they absorb tariffs? Are we worried about that creating an issue? Or is this a much more nuanced conversation between which consumer segment we're talking about, which I'm betting is going to be your answer?
You know what? It was going to be my answer, but not anymore.
Good.
I will say overall, the consumers could absorb it at their current level, but that absorption would require less consumption, which means lower GDP growth overall, because less real goods are going to be consumed, but spending will stay at a similar level because of the price hike. The most concerning thing, I think, is the psychological effect on the consumer. We saw how much the consumer pushed back against the recent spikes in inflation that we had. And I worry that if tariffs were passed at this level, which they likely wouldn't be, there would be negotiation. The consumer would feel inflation again and take another psychological hit and be very frustrated by the economy overall.
And that frustration could lead to changes in spending patterns. Is that the next dot in that, or where does that frustration go?
It would have to lead to changes in spending patterns. I think they would consume less overall. As inflation gets started, you have more incentive to buy things now if you think they're going to be more expensive tomorrow, like we're seeing with the imports. They're trying to run up inventories now because they believe they're going to be more expensive in the future. But we already had a large bout of inflation where consumers were like, oh my gosh, everything's getting more expensive so quickly. I better buy stuff now. I better do it now before it's so much more expensive. If that happens again, they've already spent down a lot of their savings. They don't have the savings that they built up from the pandemic to act as a cushion and do that spending again, which would mean they have to make decisions, budgetary decisions, and reduce their consumption.
Very interesting. And I think you just tied it all together. We have, yes, a lot of factors coming together, which affects retailers, affects consumers, and then by extension affects all of us in commercial real estate. So this is something we're going to have to revisit when we see really how policy shakes out in the next presidential term.
Yep.
Dan, thank you so much. This was fascinating. We really appreciate you sharing your knowledge on tariffs and consumers. Love it. Great conversation as always, and look forward to seeing you again next month.
Yep. We'll talk again next month. Thank you so much for having me.
And for everyone listening, that was Commercial Real Estate Now. We're happy you tuned in, and we will see you again very soon. Take care, everyone.